Copper has reached new highs not seen since 2011. Gary Wagner is a veteran trader of all things commodities. He is the editor of thegoldforecast.com, and he will be joining us to talk about copper, gold, and what we can expect from Fed and Biden statements later in the week. Gary, welcome back.
Pleasure to be here.
Gary, let's start with copper. It's a metal that we rarely talk about, you and I, because we're focused on the precious metals, but the base side is just as important. I've been hearing rhetoric for months that copper will breach new all-time highs. Has it done that yet, Gary? Are we about to see that?
It's getting very close to that. The record highs that came in 2008, 2009 were still a little ways away from there. The question is, will that be a point of resistance? Will it back off a little bit? Or will we see a clean breakout above that price point to new all-time highs? My bet would be on new all-time highs because of demand.
Okay, let's talk about this demand. Let's talk about the fundamentals first, and then we can pull up a copper chart and examine the technicals, Gary. So I've been reading reports from various economists. Goldman Sachs has talked about copper, actually, and they were expecting copper prices to go up on exactly what you said, higher demand because of the electrification of the economy, as well as the infrastructure plan that has been proposed by the administration we have. So can you talk about this demand and how much of that is behind this surge in copper prices?
I think a great deal of it is. It's twofold. First of all, the current administration's new plan to redo the infrastructure, going to green energy, which means more wiring, that's going to have a huge demand in the United States. More so, China has been using record amounts of copper as they rebuild their economy. So a combination of both together is very, very potent in terms of where we could see copper go.
I thought China was done with the with capital expenditures on construction, in the sense that, yes, that was the theme 2 decades ago in the early 2000s. Now they're shifting more towards a consumerist economy. I may be wrong. I'm curious to see what you mean by that when you said that China is rebuilding their economy and they need copper.
Absolutely. Now, in terms of their housing, they built a tremendous amount of housing. So you're probably not going to see a great need from that. However, as they rekindle and regrow their economy, that means more factories. Factories mean more use of copper. And so I do think that they will continue to use a lot of copper, and at the same time, add that to the demand in the United States. It's a perfect storm.
Mm-hmm. Okay. Goldman's report says that copper the demand is set to increase by 900% by 2030. I wonder if supply is able to keep up, Gary.
I'm not really sure. I don't really follow the mines, but whenever you get a huge increase in demand, the mines will ramp up their production.
Mm-hmm. Very good. Let's talk about the technicals then. Have you been trading copper, first of all, Gary?
I have in the past. I have been watching very, very closely from the sidelines on this particular move. I really became aware of it about a year and a half ago as it really started to dynamically take off and go into rally mode. The question now, as I said, is we're approaching the all-time record high. Last time we saw that was 2009. As we got out of a recession, I'm seeing a similar scenario play out.
Okay. Let's pull up a chart then, Gary, and let's talk about some of the technicals. And you were talking to me earlier about the Fibonacci extensions. How does that apply to copper?
Well, whenever you go to an all-time new price high, there's no historical data, obviously, to look to see how it reacted at a certain price point. Based upon that, there are only a couple of ways that you can do a forward forecasting of a market at an all-time high. And Fibonacci extensions is one of the most potent tools you can use. In essence, what you're doing is you're combining Elliott wave count and looking to calculate what wave we're in and using basic models to then forecast where the next rally would terminate.
Okay. And are we done rallying for now? You said we're going to reach a new all-time high, but is that immediately from this current run, or can we expect a pullback before it rises higher? What the charts tell you?
The charts tell me that we are so close to the record high it will make a stab at it and either back off or have a clean breakout. A breakout above would really throw stops into the market, and we would see a very, very strong move.
All right, so we're not done rallying yet. It's going to hit the all-time high, and then from there we'll see what happens. Is that what you're saying?
I believe it. Yes, I believe it will test that high.
Okay, so then would you, if you were to trade now, Gary, would you be putting in any long positions, or would you wait? Would you be shorting on momentum? How would you play this market?
Well, first of all, I'm never comfortable shorting a market that's in a dynamic rally mode.
Okay.
I would be on a neutral wait and see. On a breakout above the former highs, I would be a buyer. On a pullback, we would then chart to see where it could in fact pull back to. But right now, we are so close to that price point that I would wait to see how it reacts if and when it goes to a new all-time price high.
All right, perfect. Let's move on to the precious metals then, Gary. Like we always do, we talk about gold and silver. Let's start with gold first, and then we'll move on to silver. The precious metals have had a nice run the week before. It's still hovering around the $1,800 resistance level. It's just struggling to break above 1,800, isn't it, Gary?
Absolutely. You've got two things going on at that price point. The first thing, of course, is the fact that it's a key psychological level, 1,700, 1,800, 1,900, what I call the century marks. The second thing is we have what we call a harmonics. A harmonics is simply where two different types of technical studies conclude at the same price point. In the case of gold at 1,800, 1,802 is the 100-day moving average. What I've noticed with gold was once we identified a double bottom, which began at the end of March, we really saw the market move off of those lows. I think they were around 1670, somewhere in that area. We've moved up, a little over 100. A typically strong rally in gold will easily go $150. A weaker rally will go about 100. But what we're seeing now is, first of all, a different type of rally. And what I mean by that is it is not a parabolic move up. It seems to have a spurt to a new price point, and then it trades sideways. Then it has another price ascent, and then it goes sideways. So I term that a stair-step rally, in which you get price advances followed by a sideways or consolidating market. And that's what we've seen since hitting the double bottom.
Gary, what is the red line? Well, actually, what are the different colors, the different periods for the moving averages? Can you explain?
You'll see the legend on the side. You have a 50-day simple,
okay,
100-day simple, 200-day simple, and a 21-day exponential moving average.
Okay, so the red line, the 21-day exponential, has just crossed the 50-day moving average. And I'm just looking at it. The last time that's happened, which I think was a couple of months ago in early 2021, that was the last time I saw that pattern. Gold continued to spike up for a bit.
Correct. Now, the reason we added the 21-day is gold has been in such a protracted decline, meaning once it hit the highs in August of last year, we had a methodical move to lower pricing. And when you get that, the longer term moving averages, like the 200 and 100-day, are simply not going to be sensitive to short-term bottoms. And so that's why we've added that shorter-term moving average.
Nice. Okay. So can we expect a similar pattern then to the upside as we saw in early 2021? Because remember, if you were to identify that uptrend when the last time we had that cross, it spiked up and then it came back down. So my question is, can we expect this recent rally we've had to continue upwards for now at least?
My take on that is the last time we saw gold really, really run, besides what happened in March of last year, was the recession back in 2008 and 2009. The cause for both equities and precious metals moving in tandem to the upside was the monetary policy of the Federal Reserve. Easy money is really the name of the game right now. And so when you have easy money, it helps the stock market because companies are able to borrow. At the same time, you get potential inflation. Right now, we have, 2.6% inflation. And so that would be a concern for gold traders.
Would you agree with the notion that based on the longer term 6 month price pattern, gold is still in a bear market?
I think that doesn't hold much water only because last week we saw it break back above the 50-day moving average. Now, if you're referring to the fact that when we align the 200-day, 150-day simple averages, it is still in a bearish formation. Silver is not. Silver has the 50 on the bottom, then the 100, then the 200.
Why is this? So are you saying there's a divergence between silver and gold? Can we take a look at the silver charts?
Sure, we'll go ahead and pull one up. It's not so much a divergence as they have been moving in tandem to the upside. However, silver has consistently outperformed gold in terms of percentage gains. But as they say about a bright star, it shines twice as bright for half the length. When you see silver go down, it tends to have the largest percentage drawdown.
Sure. And would you say that gold, well, we've talked about gold, would you say that silver is also in a short-term bull market? We saw that bullish formation in gold. Did we see that in silver, Gary?
Silver's been a strange commodity in that when gold ran to a new all-time high back in August, went to 2,088, prior was 1920, silver did not. Silver touched upon $30. So in that aspect, they're both in bullish scenarios, but silver was unable to test the all-time record high that it obtained on two other occasions. So for that reason, it is different. However, when we look at simple technicals, silver is still in a true bullish alignment in terms of the moving averages. Gold is not.
Historically, the gold-silver ratio has been trading at around, 50 to 60-ish. We saw it break to new all-time records last year. It was around 120, higher perhaps, actually. And it's been trending downwards ever since. Right now, I'm looking at the chart. The gold-silver ratio is at around 68.7, 69. And so would you say that we've more or less normalized in terms of the gold-silver ratio, or would you say there's more room to climb down?
Well, it's certainly gone to the lower end of the range as silver has outperformed gold. That's when you would get a narrowing. In other words, it takes less ounces of silver to purchase 1 ounce of gold. When we saw it back at the 100, 120, it was the opposite. In other words, gold was outperforming silver. Right now, I would think that we have pretty defined parameters between 50 and 60 and 120. We're certainly at the lower end of the range. We would really need to see silver move to a new record high for it to go much lower than, say, 50.
I would assume, and correct me if I'm wrong, Gary, but I would assume that in a bear market, like in a bull market, silver would move more than gold. So if gold goes down, which it has this year, you would expect silver to go down even more, would you not? But yet the reverse has happened, which is why the gold-silver ratio has declined.
Well, when you get a decline, what is it saying? It's simply saying that it takes less ounces of silver to buy a single ounce. So you're actually seeing silver outperform gold. Correct. In terms of the percentage gain. All things being equal, I would expect both metals to continue to rally, especially if the current administration is able to enact into law this huge infrastructure plan, because that has a big segment of it about going green. One of the primary uses for silver on an industrial basis is in solar panels.
Mm-hmm. Let's talk about the current administration now. We're expecting President Biden to make a statement this week. What can you expect from his address? And as well, we can talk about the Federal Reserve as well. The Fed is meeting this week.
Well, that's difficult to say. From what I've read, it's obvious that he wants to touch on first quarter GDP. We've definitely seen us kind of turn the corner in terms of the big recession last year and the way the economy has been rebuilding. Mm-hmm. However, at the same time, we are ahead of the curve when you compare our growth to other countries. The European Union, for one, has recently come out and said that they're not in the same kind of ballpark in terms of growth. You've got tremendous issues in India right now with record numbers of COVID-19 spreading amongst their population. That will slow the economy down in that part. So while America has really seen an uptick in the economy, we have to underscore that the economy now is a global economy. So if all of our partners are not doing well, that is going to drag us lower or sustain our any kind of robust growth to a smaller extent.
It's now a global economy. What do you mean by that, Gary? Has it not always been a global economy?
It's always been, but it continues to get more and more interconnected. An example is in the United States, we're having a tremendous shortage of cars. Why? Because the chip manufacturers were unable to meet the upcoming demand. And those are produced mostly overseas. So it is kind of like a dog chasing its own tail. They're all interconnected, tighter than they were 2 years ago or 4 years ago or a decade ago.
Okay, so Federal Reserve address as well. Can you expect any changes to monetary policy from the meeting this week?
I don't believe that we will. I think the key to watch is how Chairman Powell addresses the recent rise in yields and whether or not he can kind of talk that away as a momentary blip, because that has been his stance up till now. And in fact, we saw the yields go up past 1.7, 177. They're back around 1.59, 1.57%. So in that way, he was correct. However, the consumer price index that came out for March ticked up to a very high point of 2.6%. That's inflation, and that drives gold higher.
Okay, and so finally,
I expect him to try to calm the markets as best he can.
Very good. Okay, well, we'll look out for that, Gary, and we'll follow up following the meeting, Gary. Finally, before we let you go, talk to us about the trades you've made recently and what you can do with whatever markets are in your radar this week.
Well, we were in silver, futures, and Forex. We pulled profits last week. We pulled profits on our ETFs, which is SLV and GLD, and we are still long gold from 1744. Market's at about 1780. So it's got a nice profit for us, and we've moved our stop up as a protective stop to lock in profits, even if it was to come down here. We will remain long gold as long as we continue to move our stops up.
What is your preferred trading instrument for gold and silver?
Futures, the COMEX and Globex, absolutely.
Okay, very good. Gary, thank you very much. I look forward to following up with you again soon. Thank you as always.
Thank you for having me.
I'm David Lind. Thanks for watching Kitco News. Stay tuned for more coverage.